we have the pleasure of hosting Muktar Mohammed, who is joining us virtually. Glad to have you join us on Early Exchange this morning.
Thank you. Thank you for having me. And compliment of the season. I don't know if I've been on your program this year, but compliments of the seasons.
Yeah, I would like to say, I wish the same, and be glad to be your host this morning. It's always a pleasure having you around on Early Exchange.
Thank
All right.
you.
Now let's look at this figure. According to the Nigeria Bureau of Statistics, the latest figure being released is 28.9%, looking at the consumer price index. We'd like you to provide a background and for our viewers to understand the significance of this and what will be the impact of this on the common man on the street. Give us a better understanding.
Well, thank you again. I think the better understanding is already being felt by the common man on the street because cost of goods and services have gone up. It's not going down anytime soon. If you look at those inflation numbers, I think it was in a program I'm saying that we are doing copy and paste in terms of addressing inflationary pressure. And one of those things we are doing is that we are not attacking the real issue. We are just trying to deal with the symptoms. Why the disease is still there. Instead of trying to get a cure, a medicine for the disease, we are just following the symptoms. And if you look at these figures that came from Bureau of Statistics, it shows that food inflation, which is what concerns the ordinary man, is the one that had the highest inflationary pressure, which is about 33.2%. So I mean, sorry, about 30, I think 33.2%, which is high, and that's continued to be high up to this moment. So I think what we've seen is what that means again is the cost of food has gone up, the income of the average Nigerian has not gone up, and so we are not having any solution to the inflationary pressure. I'm not surprised. I think I said it before now that I won't be surprised that inflation will hit 30%. I expect that trend to continue until the first quarter of this year. Maybe we start seeing a reduction in terms of inflationary pressure. And again, that we might want, will we be rejoicing over that, that because inflationary pressure has come down, then now cost of goods and services has come down? No, we might not enjoy that. We might not see those costs come down because, again, inflation is one thing, cost of production is another thing, macroeconomic activities is another thing, the monetary policy activities also on that thing that for inflation. So until we get these three variables to come together, we'll continue to suffer this inflationary pressure that we're encountering now. So it's not anything good news yet, but it's not bad news. Remember that the government said they are going to declare an emergency in the food sector. The president have declared that we'll soon have green revolution. They have said that they have ordered that they should release green into from the warehouse to a lot of farmers. But like I said, we can't begin to see those impacts immediately because where we are today didn't take us 1 week or 2 months to be there. We've been going through this process for the past 11 months. So it might take time, especially when you are dealing with agricultural products that have seasons. So definitely for now, I think that challenge is there, but I think it's not all bad news if we do the right thing.
What is the way to go about the rise in food inflation? Now, we've seen that food items that have contributed to the food inflation rate being at 33.93%. Majorly, food items that are consumed locally and some of them being made here. So what can we do about that?
Well, I talk about local consumption and I talk about the cost of production. So even when we do this food locally, then the cost of production, you need to put it. Not to forget that cost of transportation has gone up, so that will also goes in line with cost of production. You have the insecurity problem. Most of these farmers goes to their farm being guided either by private security or have to pay fee to the bandits to get their goods up back to the market or through. So a lot of things are involved in that too. And also, you must not also forget that we have the issue that we have to do with the machinery. Sometimes some of the machinery that are used for these productions are not made locally, so they have to sort for FX to bring this machinery in, and sometimes they have to sell through the parallel market, which is not even available. So when you look at that, you won't be too surprised where you are now, what you're seeing. presently now. So yes, and then if you look at some of those that are at the height of inflation, like you said, those that are locally produced. Also, you also have to look at those that are foreign produced, and yeah, you look at how much of those products are being used. The local, how many Nigerians patronize the local, and how many Nigerians patronize the foreign goods. And when you look at cereal like milk and others, you realize that a lot of Nigerians patronize the foreign mix than the local mix. So, and again, like I said, some of these machineries also are not produced here. So that add to what we call, what I have said about the cost of production. So that is the major factor driving inflation in local production for me. And that could be addressed if we begin to come up with palliative and means on how to drive local production, and which will be cheaper.
All right. Nigeria has maintained a double-digit inflation for a while now, and according to the projection you made earlier, this may likely dovetail to the first part of this year. I would like you to talk about some of the things the federal government needs to do, on the short term, then on the long term, to curtail this trend so that the inflation rate could, if not maintain a single digit, we can have a better figure or statistics as the year goes by.
Yes, like I said in my introduction, I said that we are doing copy and paste. We are not looking at the main cause of our issues, and we try to hike rate, we try to do a lot of things. The CBN, former CBN governor, unorthodox way, trying to do direct intervention. Like I said, we are just attacking the symptoms. We are just not dealing with the root cause. The root cause. I can tell you that the root cause of inflation in Nigeria has to do with exchange rate volatility. If you address the exchange rate volatility, you see inflation will naturally come down. That happened in Kenya. It did that, and today inflation has come down. You can see inflation coming down in Ghana too, because they've been able to address those effects issues. So for me, I think what we need to do is to continue to look at ways that we could address this volatility. Volatility is key in especially FX volatility. And the way we can do that is making FX available for agricultural items or machines. But again, you don't even have the FX, so how do you want to make it available? So we have to attract FX into the economy. We have to do that. NNPC is helping. We have about 2 point something billion that have come into the foreign reserve, part of what we want to use to stabilize the exchange rate. And we saw that play up in the autonomous exchange market, where the rate went low at 835 naira to the dollar yesterday. So maybe hopefully when we address this exchange rate volatility, we'll see definitely cost of inflation, cost of goods and services will come down, because inflation, FX volatility is the root cause of inflation in Nigeria, not hiking rate. Rather, when you do the hiking rate, it has also gotten that to increase the cost of production, especially for local people. By cost of funding goes up, and so they borrow at a higher rate than a low rate. The other way is for government to go into the farmers and begin to give them single-digit loans. I remember we've done that before. We did it during the time that during President Goodluck Ebele Jonathan time, when the current president of African Development Bank, Akinwumi Adesina, was the Minister for Agriculture. We saw how that worked, because they didn't do it directly to the CBN like what happened during Buhari administration, but they did it through partnering with the local banks, because these banks are able to identify these farmers through what they've done through their accounts, not what we saw in the rice anchor borrowing scheme, where the CBN directly was funding politicians in the name of farmers. So we need to look at that again. Before now, we used to have agricultural cooperative bank, where the farmers come together and set up a cooperative society, and they're able to accept loan, and they were able to help in agricultural production, bringing down the cost of goods. We've not seen that again. That bank went under. No government have tried to revitalize that bank again. Also, government say they released green for farmers. But it seems that farmers are not seeing this green, so the government need to look at that aspect. So, and fortunately enough, the president have declared an emergency for food and security. Hopefully, we'll begin to see those results going forward in the near term.
All right. Now, if you look at the pattern of the rise of inflation in the year 2023, it kept rising from month to month, except for a month or two where it had just a slight decrease. But it's consistent with the pattern of rise as witnessed in 2016 and 2020. Is there anything significant that is of common among these years, 2016, 2020, and 2023? Is there any lesson to learn there?
Yes, something is common. Remember in 2015, after Buhari came to power, then exchange rate went to as high as 500 and I think 520. And then when we came up with the import-export window, then we saw that rate come down to about 360, and we maintained that for a long time before the pandemic came and everything went back. So that's so definitely that brings us back to what I'm saying, that if you look at that pattern, you realize that from 2020, 21, 22, 23, exchange rate has continuously been very volatile, especially after the COVID-19 pandemic. So you can draw that scenario that the challenge that is driving inflation in Nigeria thus far has to do with exchange rate volatility. So what are we supposed to do? Address that volatility. How do you address that volatility? Make FX available for farmers, especially those that are into agriculture, maybe they are importing these goods into the country, the machineries, can they get a tax waiver? A lot of things that government can do. We just have to learn from the Kenya experience. Kenya decided to give tax waivers to some of these agricultural items, and that brought down the cost of production. So we need to begin to look at that. But again, when it comes to waiver, it has been abused. So we must make sure we are giving the waiver to the right people that need to bring this product to Nigeria, machines or whatever they need to bring into this country. So I think if you look at that, thank God you've pointed it out. From 2015, remember it was 2016 that President Buhari came to power. And before Jonathan left power, that 2015, we started seeing this rise in inflationary pressure because of the exchange rate. And I think it was in 2017, maybe towards late December of that year, when the then vice president was acting president, and we came up with the import-export window, and we allow market forces to determine. We moved the exchange rate from about 250 then to about 360, and we saw everything stabilize, and we enjoyed those flow until COVID-19 pandemic. After that, up to this moment, we are still suffering from inflationary pressure.
All right. Let's look at what may likely play out come April 1st, when the federal government intends to increase the national minimum wage. Going by the concept of inflation or the general definition of inflation, what might likely be the impact of this if the federal government increases the national minimum wage come April 1st?
One thing you should know is that I think they are driving it to April 1st so that they should know that inflation has come down before they increase the rate. I can tell you that it's not the minimum wage that will definitely help inflation flow. I keep saying it is the exchange rate, and I repeat it. If at April exchange rate is still volatile the way it is now, you've not attract inflow, you've not been able to stabilize the exchange rate. Even if you increase the minimum wage or not, inflation will still be there. If by April you are able to stabilize the minimum wage, then you are now you increase workers' salary, you will see that the inflationary pressure that we are fighting will not be there that much like what we are encountering now. Not to forget that Nigeria is a consumer-driven economy, whereby we rely on companies that are bringing in consumables. That's what drives our economy. And that sector has not strived for a very long time because the earning capability of an average Nigerian has gone down. So what you are seeing now is just that even when you are dealing with inflation, you are also dealing with a lot of companies not making sales because people are not buying the way they used to buy before. And that also is driving these companies to reduce their workforce. So that's what I talk about microeconomy. So that is a microeconomic issues that need to be resolved. Monetary policy, you stabilize the exchange rate. Microeconomy, you have to pay those living wage so that people will be able to purchase, so that companies will not be sending people home. And then once you deal with those two factors, you will see that naturally companies will begin to strive. Employment will be available for Nigerians, youth, and other Nigerians. And then you see that rate will come down once there's stability in the exchange rate. Then you see inflation will naturally come down. I don't think that the major cause of inflation will be so much because minimum wage was increased. I think the major cause of inflation, which I think the CBN or those in the economic team of the president know, is exchange rate.
All right, now let's look at the expected growth rate for Nigeria. It expected that Nigeria's economy will grow at 3.4% between 2023 to 2025. We are in 2024 now. What should be done differently to achieve this or even surpass the projected growth?
Look, I'm not so much excited when it comes to growth because we have seen that growth in Nigeria has to deal with production of crude. Once we get it in that area, then our growth comes up. I think the one we should be looking at is the real growth, a growth that will come from the bottom up, not from the up down. The growth that we're seeing in the Nigerian economy has to do with revenue for government because of cost of output has gone up, so government tend to have more revenue. When we talk about the real growth, how many jobs are being created? What we should be looking at, not because of growth in terms of of output. And then we are selling more, so it's like a company that is improvement. There's improvement in your output, and then but again, the profit margin is still low because a lot of things are not being done well. So the same thing that has to do with Nigerian growth rate has mostly to do with our able to produce, especially our output in the oil sector. So we need to begin to look at growth of our economy in the area of how many jobs were created, how many companies came into Nigeria, how much did we attract in terms of foreign direct investment, how much do we attract, what happened in capital exportation. So those are things that we need to begin to look at to begin to address our growth rate. So for me, I'm not too excited when it's all growth these days. So all the government will increase production and then growth rate will go up. But the real growth rate that will determine the prosperity of your economy is how much job is provided, how much people are moved from the poor to the middle class, and how much are moved from the middle class to the rich. That is what determines your economic growth, not because of the output that you are doing. So I think government should concentrate more on the area of growth, the real growth in terms of the bottom-up approach, rather than looking at production.
All right. Let's go to this report suggesting that banks in Nigeria, are battling with impaired loans. For our viewers to have a better understanding, I would like you to provide a background and explain to us the concept of impaired loans. What are the factors responsible for this development?
Yeah, for viewers, I think it just impaired loan is loans that were not. A lot of people could not pay. Maybe you promised to pay, you're supposed to pay at the end of the year. You could not even pay, and the interest keep accumulating, and yet you're not able to pay, and that's the challenge. That's just in simple terms, not able to pay your loans that are collected for business or one thing or the other. And so we've had those challenges. Like I said before we went on break, we're a consumer-driven economy. A situation whereby you're producing and a lot of people are not buying, then you will not be able to make sales. And so when you're not making sales, you'll not be able to pay your loan. So it's as simple as that. That's what is happening in our economy these days, because we are producing so much that people don't have the earning capability to buy as much as they used to buy before. And we've collected this loan to expand, thinking that, okay, because of the population, because of our sales before. And so for me, that's why we are having the challenges we are having in terms of impaired loan, because consumers are no more buying, because people that used to buy two now buy one. Some of them don't even buy again. Some of them look at other means where they could buy. And some of these companies are not able to service their debts because they are not making sales.
Let's look at the interest rates too. Does it have anything to do with why the rates of impaired loans is rising?
Yes, it could have. Yes, it will have definitely, because again, once rate is high, your cost of funding go high, cost of payment go high, and then cost of business it's also gone high. But again, the one you don't have control over is how many number of consumers are now going to come and buy your product. So when you drive all these costs high, and yet again you are not able to have people to buy it, definitely that means you will not be able to service your debt. So basically, it's just like a snowball effect. What happened to one then happened to the other. That's why we keep saying that to address Nigerian issues, especially whether we're talking about reducing parent loan or whether we are talking about taming inflation, we need to begin to look at stabilization. We need to begin to do things different. We must come up with our own homegrown economic methods, which has to do with what is peculiar with our systems. You see, we started this hike with America, with the UK, and today inflation has gone down in those places and we are still battling it. That tells us that we are just doing copy and paste. We need to do things structural. We need to look at our economy. Do we want to build an ingrown economy, or do we want to build an economy that should be global? Then if you want to do that, then if you're thinking of global, you need to attract those investors. You need to stabilize your rate. If you're thinking of doing an ingrown economy, then you need to begin to think about social interventions in some key areas of Nigerian economy to drive to make sure that you bring down some of these challenges that they are encountering. So it's a big challenge, and why we are not feeling that in the banking sector today, because you said, okay, the banks have now having payroll loan has gone up, but yet you are not seeing it in their balance sheet. Just has to do with the revaluation of the exchange rate, which make the banks to become more liquid, because the exchange rate at the time before now was 360, has gone up as high as 800 officially. So it helped their balance sheet to grow. But the real sector that are supposed to drive your growth for the long term having challenges paying those loans. So it's a big challenge. It's a time bomb that is waiting to happen if something is not done urgently.
All right, let's also look at the accusations of insider borrowing in some of these banks. If there's anything to go by, what can be done to check that?
Corporate governance is as easy as that. And that's why we keep saying that, and the regulators need to be up on their game, because insider borrower is something that the regulator would definitely know when they are auditing this result, because some of all these things come up when you are auditing the bank result. So you need to look at insider borrowing. It's not so much of a big challenge, because if you look at some of the loans, like you said, most of them are not really driven by insider borrower like that, but of course they are there. Or maybe they are fronting for one company or the other. These are meant for the regulators to really deal with. That's why we say you cannot build $1 trillion economy with $1 billion regulators. So you need to also make sure that your regulators are trained on how to handle $1 trillion economy, not just $1 million economy. So that boils down to regulators not doing their work, because insider trading is not something that cannot be seen if the regulators are really doing their work, which is to make sure they audit this bank and to know who you are giving this fund and what these funds are meant for, and to make sure that these funds are being paid back, because remember, it's shareholders' money that are there, and also it's bank customers' money that are being used to give to these people.
All right, interesting. What a way to wrap up this conversation. Muktar Mohammed, we want to appreciate you for your time and your submission on the issue of the inflation rate, and also talking about the impact of impaired loans, which has become an issue to reckon with. Thank you for your thoughts and providing the right perspective as regards these issues.
Thank you for having me. It's my pleasure always. Thank you.